What's up, everybody? Welcome back to another episode of the Next Deal podcast. As always, my name's Justin. I'm your host, followed by he's also the host as well, Vince Hall. Vince, how you doing?
Doing good, man.
I don't know why I hate saying co-host. I'm like, you're the host too. It's we both have equal amount of talking time, so it's the same damn thing.
Well, we're 50-50.
like from The Office, like co-managers.
Right. You manage the day-to-day, and I manage the top now.
yeah, there you go. Well, anyway, I'm super excited for today's call. We do this occasionally where we bring somebody on who's not actively investing in real estate, but helps real estate investors. We've got Payton Gillis on today with us with company is TPG Firm. Is that correct?
TGP Tax Game Plan.
Tax Game Plan.
But TGP Firm is what I say.
Perfect. So what they do is they help folks that are investing in real estate and small businesses, things like that, implement tax planning strategies to reduce and optimize taxes. From my experience, this is a huge area where most real estate investors neglect this until it's too late, or until you're like up against the wire and you're like, well, crap, I have to pay taxes now. It's April, right? So I'm super glad that we connected and that you're on with us today, Shane. So I don't know why I called you Shane, because we're talking about Shane Gillis right before this. Your name's Payton. Damn it. Sorry, dude.
I'll take it. I mean,
you don't know who Shane Gillis is? He's a very popular comedian right now. And have you ever seen Kill Tony?
Oh, that's the stuff you and Jeremy were talking about.
Yeah, I think his big thing was like he got fired from SNL in like a day or something.
Like a day, yeah, because he was too offensive for SNL, and they were like, no, just get out.
They hired him, and then they like looked into some of his past podcasts, and they're like, oh, we can't do this.
Yeah, like you say things
you're already canceled.
Yeah, exactly, literally. And now he does all kinds of stuff, is blowing up right now, which is awesome. So sorry. Anyway, Payton, to just kind of get started, man, how did you get started in this industry? And, what's kind of your firm's main focus when you're working with people?
Yeah. Really, the way that this all came about is I've been out in the tax accounting world my whole career, so 12 plus years now, and bounced around, was at public accounting, went to corporate tax accounting, and came back to public. And I think when it really sparked an interest and I got started to dive into it was in my late 20s, early 30s, where we had a lot of clients, but also a lot of our friend group that was getting into this level of comfort to where you start to be like, all right, we're comfortable in our W-2 jobs and we're doing what we need to do in our retirement. You kind of enter that phase. And so we had a lot of friends like that. And they were asking, well, what else can we do? We're getting killed on taxes here, right? We're getting killed. And, they needed more than just the max out your retirement account and fund your health savings account and like the basics. They're already doing that and they're still getting killed on taxes. So I'm like, well, before I've never really like pushed this on anyone, but you do know that if you were to invest in real estate or open up a side business or do something like that, that's kind of the next step. Once you do that, it opens up the book of the IRS tax code and a lot of state tax code. Like, we can start to do a lot of things. We can shift income, shift expenses, take advantages of. There's just a ton of tax advantages out there to that. And I'd never really talked to people about that previously because I thought that's not really the CPA's job to do that, really. Like, there's other, if I tell you to go invest in real estate, there's a lot more to that than just the tax savings of it, right? That's kind of the lifestyle that you need to get into. And what I found is in 9 out of 10 of the people that I would talk about this with, their reaction was more of, yeah, we have friends doing that. We know people are doing this and everything, but how do we do it? What do we do? And so I'm like, well, you're using it to build your wealth, right? What we can do, but what it can do along the way is one large piece of that is the ROI you'll get from the tax savings of doing it and how to maximize that. And so that's really when, I had friends that were getting interested in it and doing it. And so I started to build up my connections into the real estate world, getting out to investor club meetings and doing things like that. One, for my own knowledge, but two, to give these people that I'm advising, maybe you should get into real estate or a small business, because the majority of the time, their choice was real estate because they're good with their W-2 high paying job. And so or their business that they're running well. So they they would, I wanted to find people in places they could connect with, right? I wanted to find, and I didn't just want to send them like, oh, I saw this guy online. Like I wanted people that I actually met and connected with and could tell them, hey, come out to this, go meet with this guy, build up that network. And so that's what I started to do. And then then I ended up breaking off from the firm I was at and just going full blown into my own, but did that at the same time I was learning like all the, not, I would say learning, but really like just re-educating myself on the tax planning options available to them, and just kind of a mindset shift of going from, hey, we're just filing taxes and doing all this, to building out our own firm where it's, hey, no, at the forefront of everything, we're looking at how we can reduce and optimize your tax circumstances. And a lot of times it's not for the prior year. We'll look into that, but it's proactively. Okay, you didn't do this. We're going to do as best we can for the prior years. Here's what we can do going forward that's going to put you in a much more optimal state, because right now you're not getting all the benefits to this real estate that you could be.
Right. And I think a lot of people miss that too, with how many benefits there are with real estate that you can do. Like we're fortunate enough that our CPA we've had for, I don't know, 3-4 years at this point. It works primarily with investors and is very, very good at what he does, and has saved us a lot of money over the years. So from what you've seen, what are some like common mistakes you see real estate investors making that like maybe they've set something up a certain way, or they're doing something a certain way that they can change and adjust to kind of help that tax burden? What are some of those things you've seen?
That's a great question. So the couple of the biggest ones are, you guys are well versed and you have a good accountant working on it, so it's great. I see people coming in a lot of times with wrong advice, or they're not working with an accountant that's in it, so that they've given them wrong or no advice. And so the biggest thing that I see is they'll come in with these properties, and I'm like, we could run a cost segregation on that. And they're like, no, he said we can't do that. That's only for commercial buildings. And I'm like, no, it's not, and so that's the biggest piece, is they'll miss cost segregations a lot of times on properties that are good qualified properties for it, because someone, or they believe that they can only do this on a multi-million-dollar commercial building, and it's just not the case. So that's one of the common one that comes up. Go ahead.
No, you're good. Can you explain for people that are listening? Because I have found we have a lot of newer people getting started. When you're referencing cost segregation, what exactly are you referencing with that?
Yeah, that's a good question. So I'll try to make it as simple as possible, but it gets pretty complex pretty fast.
Sure.
But what cost segregation?
You mean taxes are complicated?
Yeah.
It's weird.
So what happens is you go invest into a property, and let's say it's a $300,000 residential rental, right? So you go invest into that property, and it's $300,000. The IRS is going to say, okay, we have to figure out what the land value is and everything. So usually it's around 15 to 20%, but it's very based on what area you're in and everything, right? Land in California is worth a lot more than land here in Missouri. So based on where you're at, you have to break out a portion for land. Let's say it's a $300,000 property, and we broke out $50,000 for land. It's pretty high, but $50,000 for land. So that land will never get depreciated. It stays on your books at $50,000, and you don't depreciate that or get any expense for that. It stays in your basis of the property. The rest of the $250,000 that you had put into that's going to get what's called depreciated. So the IRS looks at it as though, hey, this is going to lose value over the next 27 and a half years for a residential rental, right? So they'll say, take that $250,000 and divide it by 27 and a half years. And a few $1,000s, that's what you get to be your depreciation expense on this house every year. When you go file your tax return, and you've got your rental revenues, and then you've got your normal utilities and mortgage interest and your other insurance or expenses, they're going to give you this added expense called depreciation expense. A lot of people, like lenders in general, they look at it as it's a non-cash, it's almost a fake expense to them. They'll add it back when they're looking at stuff. But for you, it's a tax perk, right? It's why people are able to sometimes cash flow, or oftentimes cash flow off the properties, but take a loss or claim zero on those rental properties on their taxes. And that's all great that you get a few $1,000s for that building. But if you go do some rehab to that building, and maybe you get floors put in, and you get cabinets put in, and you get different stuff, every single thing that you put into that has a different depreciable life, right? So if you put floors in, that's 5 years, right? Cabinets in, that's 5 years. Like You go do some work on the driveway, that's 15 years. So all of that said, if you spent $10,000 on floor, normally they'd say, hey, take that 10,000 and divide it by 5 years, because that's the life of that. So you get 2,000 a year, right? That's how you could do stuff. However, on all of that stuff outside of the building, outside of the $250,000 building, anything that you buy to put in there, the IRS currently has these beneficial tax rules called bonus depreciation. So advanced depreciation, where they say, hey, if you buy anything like this, that's not the building, that's not the 27.5-year property, like whatever else you buy, you can take a big chunk of it up front. And from 2018 to 2022, it was 100%. It was, if you go buy new flooring, you can take 100%. So instead of $2,000 for depreciation, your expense this year is $10,000 for depreciation. So what that does is it allows people to get that cash flow a lot sooner, right? Because now their depreciation expense isn't $2,000, it's $10,000 and above, right? Mm-hmm. The problem with it is that advance, it's 60% for 2024. So if you go buy something like that now, they're going to say you can take 60% of it this year. The rest of it gets divided over the next 5 years. So if you went and bought that $10,000 flooring, you would take $6,000 instead of $2,000 this year. Still a big deduction, right? Just because the way bonuses in the code right now, it is set to go down 60% for things this year, 40 next year. It's kind of set to dwindle down. There will at some point likely be something that stops it from going too low or to zero. It's a very beneficial thing. A lot of high-powered lobbyists, a lot of people in DC have real estate.
I was going to say, we'll see what happens this
year. Bonus depreciation has been around in some way, shape, or form for 20 years, right? It's been around for a long time. They want people to invest in the economy, and they want to do things that help them. So I don't speculate on that, but I don't foresee it going to zero. But what that is to say is, on the building, that $250,000, they're not going to allow that bonus depreciation on that. So they're going to say, hey, 250 divided over 27.5 years, there's no special rules for that. So what you have to do to increase your depreciation from just a few $1,000s off the building is run what's called a cost segregation implementation. Cost segregation is, we're going to utilize an outside engineering firm. They're going to come in and they're going to essentially break apart your building, right? And they're going to say, hey, this isn't $250,000 of just the building. There's floors, there's ceiling fans, there's cabinets, there's all this stuff that made it up, right? There's stuff outside, there's fencing, there's all this stuff. They're going to then give us a report that breaks it out. And it says, hey, this building is worth $200,000 and $25,000 is 5-year property and $10,000 is 15-year property. And they're going to break that up a little bit. So now what we're able to do is take that $50,000 that they broke off and take bonus depreciation on it. Yeah. So instead of taking 250 over 27.5 years, we take 200 over 27.5 years, and 50,000 of it, we take 60% of it right away. And then we take the rest of it over 5 years, 7 years, 15. So it increases that depreciation expense a lot, right? And then if we take, let's say you have a tax rate of 25%, that's the real money that's back in your pocket, right? So at the end of the day, everything we do is to look at that. It's to look at how can we utilize tax planning and strategies that you want to do to put more money in your pocket and allow you to accelerate your wealth that much faster, right? So now you've got another 20 grand because you didn't have to pay in estimates, or you got that back on your refund or whatever, that you can now go utilize to pay something down, to invest, to do what you want to do with, right? Because that's what a cost segregation is, giving you the present value of cash flow, right? It's getting you that money that much faster rather than waiting for something to get it a little bit at a time.
That's cool.
So that's the biggest piece we'll see, is that there's a cost to doing that. And just a lot of other accountants they think the cost is too high because they're used to the real ones where an engineering firm comes in person and it costs $10,000 plus for them to come do this. That's it, and that is if you have a large building, that's worth it. But there's other forms of these studies that they do, engineering studies, paper studies that are much lower cost. We're talking $1,000 to $5,000 for the study. And what our job is to quarterback it with them and say, okay, here, what's a quote on what this is going to break out for them? Okay, here's, in your situation, this is going to save you $25,000 in taxes this year. Pay the $3,000 for the engineering study, or pay the $1,000 for the paper study, right? And then, that's what they'll do. And so they'll know kind of, all right, this is the time to pull the trigger on that.
Got it. And I'm glad there's people like you that understand this, because this stuff makes my brain hurt.
Yeah.
This is the key to having someone who is good at this when you run any kind of business.
That's my goal is always to take to make it, because I get it. It's like social media marketing or something. I don't know. I know enough, a little bit about it to learn it, but I don't know the ins and outs and how to do it. And that's my goal. Is when you talk to me about it, I need that person to be like, here's what that means. Here's what you need to do. Here's what this means. And that's kind of my goal, is that this isn't something that other people, whatever field they're in, 9 times out of 10, they don't know it unless they just get excited about this stuff, which is very rare. And so they're, that's the goal of mine, is to take this and make it understandable for them, for their spouse, so that they're like, okay, that's why we're doing this.
Oh yeah, I understand cost segregation so much better now.
Yeah.
I'm gonna have to re-listen to it again to
I know, right?
It again.
That's all. The other one I wanted to go into, just because this happens, and it's probably one of my biggest don't do it, that I love. I want new investors to understand, is entity structuring on this stuff, because I know. Justin, you and Vince, I know you guys do some flips and things like that on there, but I know that people don't understand the difference. A lot of times they don't understand the difference in investments, because how real estate investors view investments is different than how the IRS views it. To the IRS, real estate investments are long-term holds and short-term holds. They're buy and holds. You have a building that's getting you rent. They are not flips. They are not wholesale. They are not, all that's business. So that's a big distinction for people, is that's what investments are to the IRS. The other stuff, flips, property management, wholesaling, that's all, you're running a separate business doing that. And that's a big distinction. One, because of the tax entities that you might want both in. There's self-employment taxes on things that are business. So the flips and all that has self-employment taxes, whereas investments do not have that. And so the biggest thing that I see or a big issue that I'll see at times, is people putting real estate into S corporations, their investments into the S corporations, which is almost always an awful idea. Very rarely is that a good idea. It can really hurt you. And so that's the other piece to it, is you generally want your properties put into an LLC or a limited partnership, or however you want it, but you generally do not want those put into an S corporation or even a C corporation for the most part. There's some very negative tax implications that happen there when you do that, or that can happen when you do that, and there's usually no real benefits to doing it.
Yeah, that's a good point. I haven't made that mistake, so that's good to know. Yeah. I haven't done that because because Ballpoint, Call Porter, those are set up as S corps. So. So here's a good question for you. So let's say I've seen this a couple of times, and we're considering it as well, where I'll just use Ballpoint as an example, right? We market for people. So we have a ton of access to sending out mail, getting leads, being able to get deals. If we want to start buying assets under Ballpoint Marketing, which is an S corp right now, would it make more sense to have a separate LLC then that is under a parent company kind of thing to do that?
Yeah. So if the assets are real estate, definitely. If the assets are, hey, we're buying vehicles and things like that, or different, whatever the assets are, tax wise, it may not change anything, but legal wise, you might want that split, just because, again, talking with the attorney, you're wanting protection of those assets from the operations of the company, and vice versa. So that's the other piece that comes up entity structuring wise, is that we usually get the question, do I need an LLC? And I'm like, that's really, you're setting that up for legal purposes in general, that, which is, and we'll touch on it. We can't advise on it, but we'll touch on it. And so I'm like, there's two pieces to it. So to that point, I think from a real estate standpoint, that's when the holdings company comes up, is that it makes more sense to put that in there. Potentially hiring children, that comes into play at that point. You generally don't want to hire them in the S corp under 18 years old. You generally want to hire them through a partnership or an LLC. And so things like that. So it's nice to be able to have those multiple tax entities. What was that, Vince? Sorry.
I said, hold up! I got 5 kids. We need to talk about that.
Yeah, get them hired. Yeah, that's a lot. That's a lot of the stuff we do. Is like it's more hand holding. I think with what we do for our clients, like on our tax game plan clients and everything. It's a lot more like, what I saw in the past was Vince would come in and I'd be like, hey, Payton, I saw a strategy or something about I could hire him now that he's 14 or 15 or whatever. And I'm like, yeah, this is how you do it. Like, go do that. Yeah, that's how you do it. And then Vince comes back next February and he's like, I'm like, did you do that? Did you set him up and everything and give him a W-2? He's like, no, I gave him like $6,000 last summer when he helped me out on stuff. Like, so can I deduct that? And I'm like, not great. Like, not really. Like, I'm like,
not the way you want to.
Here's what we're looking at if you do it. And so whereas now when Vince comes in and he's like, yeah, usually it's us bringing it to him like, hey, is this something that you'd want? And then, usually they're like, yep, I could, or no, that he'll never work for me. Those types of things. And then I'm like, okay, great. We're going to go ahead and get him set up. We need you to give him the job description that you want him to do. We're going to kind of give you the green or red, like, yep, that all works, or no, you need him to do more. You can't just clean your home office type of a thing. And so those types of things, we're going to get them. We're going to set them up on the payroll. If we're setting up like a retirement account to get them some tax-free money, we're going to work with the financial advisor to do that. So kind of just a full scale, because it's like anything. Like it's like getting my license renewed. Like I don't want to go deal with that. I just want done. So it's that's what we've found is like they just want it done with taking as limited of what they need to do as possible.
Got it. Okay. Very cool. Vinny's got a real life situation right now, actually, that I know he's got some questions about.
So I've always life hacked my way to bigger and better properties.
Yeah.
So I've always bought a property that needed some work, fixed it up, lived in it for a few years, sold it, used the proceeds to buy another house, fix that one. I did that. I've done that like 10 times.
Yeah.
Right. And have never had to pay taxes just because of,
personal
primary residency, things of that sort. However, this last time, my primary residency, I actually turned into a rental for 1 year.
Okay.
And I'm selling it. Am I required to now pay taxes on
how long did you live in it personally? So how many
3 years.
The past 3 years?
Yeah.
So you have to have lived in it 2 out of the past 5 years to take the exemption. So perfect. As long as you lived in it for 2 of the past 5 years, if you're married, Vince, and your spouse, like if Vince lived in it for 2 of the past 5 years, you got $250. If your spouse lived in it with you for 2 of the past 5 years, you got $500,000 of gains, right? So if you bought it for $500 and you sold it for $1 million, you wouldn't pay tax on that and everything. But
that's this one's still in my name. It's not in the business or anything like that.
Yeah. Generally, it's 2 of 5 years that you have to have lived in it, and it had to be your primary residence for 2 of 5 years.
Yep, it totally was. It was kind of a situation where we could have sold it then, but I wanted to kind of toy around, tinkering as making it a rental in a really good area. However, this really good area, I would be dumb not to sell it for what it's worth right now. Just personally. So I'm just kind of like, I want to keep it because it has a 2.3% interest rate.
Yeah.
It's hard to get.
I know it's never going to happen again. But I do all my, everything through like a VA loan too. So I've always kind of life hacked my way through that because on a VA loan, I can get up to, I think it's like $800,000 now, but you can have as many properties as you want. As long as it's under $800,000 on a VA loan, you're not paying PMI, no money down, anything like that. Yeah,
that's awesome. Yeah, lending options like that. I love learning more about like lending options and things. Whenever like people are like, oh, I do DSCR, I do whatever, just because I'm like, wow, there's like so many different ways to get the money, and I like learning about it and also learning about, hey, what are things that we could do wrong on their tax return that you don't want to see or that the underwriters don't want to see, right? Because that's that's what we want to avoid and stuff when we deal with people. Right. So it's like, there's times that they come in like that. And I'm like, no, you're trying to go get a new primary or whatever. We want to show some income and things like that. So, don't do anything crazy. So, but no, that's awesome. I think you're able to do it. But yeah, you'll lose out on your great 2% rate.
Yeah, it'll go to bigger and better things. The proceeds for sure. But yeah, and speaking of taxes and being a veteran, I still am a firm believer that I went to war. I should at least have some sort of tax, something. But they're like, "F you, we don't care. You get to pay taxes like everybody else."
You're lumped in. Sorry.
I
do get a lot of other good benefits, but I'm just like, come on.
We get that questions like, "Hey, am I out?" And I'm like, "You get this little bit of break from Missouri," and like that's like, like it's, while you're active, like while you're like there's
Oh man, yeah, dude, I thought 3% was good that I got, and you got 2.3. You beat me. That's the only reason I haven't sold my house. I'm like, I really like this 3% interest on this house.
I always joke because like during that period, like we refied once and we got down, and then the mortgage lender, who's my friend, he's like, hey, you should do it again. And I'm like, are you telling me to do this one more time just like to drum up business, or like is it really worth it?
Right.
And he's like, no, I think you will. And it dropped us like another quarter, and then it was like 4 months later that everything like started going the other way. And then I didn't like, it was like a year later, I was like telling someone and thinking about that. I'm like, yeah, I need to take him to lunch. Like he wasn't.
I know, right? So. we did pretty similar. When we bought our house, we didn't have great credit. We didn't have a ton of cash or anything at that point. And it was like 6% interest, like something stupid like that. Like what would be a great deal now. And our mortgage guy reached out to us, and I forget how far, it was like maybe 30 days before rates skyrocketed that we closed 30 days before rates skyrocketed. And we went from that 6% down to 3%. And then like a month later, things started going up, and I was like, I love you. Like, I'm so glad I responded to your email.
Because usually like, and even with his, I was like, because if it is drumming up business, I mean, I'll do it even if it's a break, even if it helps you, but like, no, it's like, no, we should actually do this. So
So question I had, I wanted to go back to the cost segregation side of things. That's more set up for a long-term rental, right? That strategy itself.
Long-term rental versus what other?
Versus like a flip or a wholesale, something that you're very quickly moving through. Yeah. It's not a longer term asset.
Yeah. So when the long-term rental, because that's an investment, that's an asset, right? So that's the asset that you have. That's on your balance sheet. When you have a flip, they look at flips the same way they look at that you're selling widgets next door, right? You are just in the business of selling. The inventory is your houses. So like your inventory isn't shirts, it's houses. So what happens, you buy the property for $300,000, you put $100,000 into it. It all builds your inventory. So, hey, I've got this property. My inventory is $400,000. There's no depreciation or anything like that on it. And then you go sell it for $600,000. Then they figure out, okay, you had 600 minus 400, so $200,000. That's your income. That's your revenue, right? Like that's your, so it's revenues minus cost of goods sales, and that's your net income, right? So 600 minus 400 is 200, right? So that's how flips work. They look, and that's why most people, once they're making, significant money into the, like above 50, 60 grand from it, depending on everyone's specific situation, but they at least start to be like, hey, we need to make this an S corporation, because otherwise we're going to pay self-employment taxes on that $200,000, right? On that money that we've got there. Whereas when it's a rental and you sell that, we're talking about capital gains taxes. They're talking about 1031s, things like that. So yeah, to the point, like most things on flips, usually things like the flips and the wholesaling, that piece, like when we set it up for people, I'm like, that's your active money, right? Your wife's W-2, all that, that's on your active side, right? And your goal over there is to make money, right? To swim in the money, right? You need to make as much money as you can over there.
Would Vince say Scrooge McDuck in the money?
Yeah. It's like you need to make your money. Now we're gonna maximize shift expenses and talk about how to make sure that like you get as many deductions as you can on that money. But that's where you're gonna make money. Then once you make that money, what you're going to continue to put it into is either back into those active things that are making you money, or ideally you want to be at a point where you can put it into the other side, the passive side, which is your investment properties, right? So buy more investment properties, alternative assets, stock market, whatever it is that you like to invest in, get that built up so that you're creating assets that are going to give you passive income.
Yeah.
And then the real trick is over on the passive side, especially with real estate, we can utilize a lot of strategies like cost segregations and 1031s and things. We can use a lot of strategies to get taxes to zero and oftentimes large losses, right? And then the real trick where it gets fun is how do we take those passive losses over to the active income side to offset it? Because that's where the IRS makes it hard. They'll let you use those passive losses to offset any of your passive income. If you had income from investing in real estate syndications or things like that, they'll let you do that. But they make it pretty challenging to get it over to offset your active income, your W-2s, your flips, your wholesales, your property management. That's where it comes in that they want you to meet real estate professional status and things like that. That's the benefit to that.
Got it.
Now we can cross that barrier and do that.
Okay.
So that's what our conversations with clients a lot of times is, hey, we can create this loss over here, but does it make sense? Because can we use it? It doesn't make sense to use a cost segregation if you can't qualify for real estate professional status, or we don't have passive income, or you're not using like a short-term rental loophole or something. Like, we can't get that over here. It's just going to carry forward on your tax return for years until you sell this property or create passive income. So that's the conversations that we'll have. So a lot of timing comes up with that and everything. But
got it. So if there's there's something that I see a lot of investors and, I'm in different coaching groups and things like that we've seen this come up a lot, where a lot of investors will get started as wholesalers or flippers to start building their active income. Then they stop and buy rentals, and then they run out of cash, and then ultimately have to sell that rental to go back to build their active income. So
yeah.
I definitely see what you're saying with long-term having those rentals. There's ways to offset taxes in your active income, but if someone's just strictly a wholesaler, right? And that's for the time being, maybe it's a year, maybe it's 3 years, however long, are there certain things that wholesalers or flippers specifically can do to help mitigate those taxes? Because I know, like you said, it's more of like your cost of goods sold, all that kind of stuff, and it's treated more like an actual business.
Right.
And I've seen it play out in like Ballpoint and Call Porter, how that has worked for us with showing, not having to pay as much taxes with certain strategies our CPA has done with us. But I'm curious, just for, let's say it's a brand new wholesaler who's brings in 150 grand this year, and they have no idea what they're going to do with taxes now. Very curious about that.
Yeah, for sure. Yeah. Usually with them, the two like first steps are maximizing your deductions. So understanding how to maximize deductions as much as possible on that business income, pure business income. And a lot of times that is taking expenses that you're already paying out of pocket and making those pre-tax, right? And there's ways to do that and things to do that. Things like travel, meals, office supplies, IT, subscriptions, a lot of things, telephones, like there's a lot of things that they don't, what I find is that people, when they come in, they're either doing them wrong or wrong. Like they're either doing them, most of the time they're coming in and they're like, well, we don't take that because that's mostly personal, or that could be seen as personal. Or we're taking this, but we're not documenting it, and we're not, and that type of stuff. Like either we're paying for the meal and we're taking everything, and like, no, this doesn't qualify, or we're not doing it because we're not sure. And so a lot of what we do is the education and the consulting for them. Like when we have someone come in like that, like they're usually on consult, and there's kind of consult or planning. Usually they're on consult, which means the value we're going to give to you is the consultation and the education, right? Like we're going to get, we're going to do that. We're going to educate you on how to maximize travel, maximize this, use an accountable plan or a board of advisors so that you can get your spouse or your adult kids or your friend, brother, sister, whoever's helping you in this business outside of being like an employee, and maximize deductions that you're paying for them already. So those come up a lot, and taking things like, hey, you're going on this trip personally. If you want to bring business into it for a day or a couple of days, here's how you could maximize and save on your, we could take a percentage of that flight or that mileage and stuff like that. A lot of times it's maximizing deductions first. That's always where we start first.
Okay.
And then entity structuring from there. So that then becomes, okay, they're at a point now, very likely if it's a single owner, like they're looking at, and again, all situations are different, but they're usually looking at getting the S Corp set up and rolling and doing all of that. Like a lot of times people will think that, not a lot of times, but I've seen it where people are like, oh, that just takes like filing a form. I'm like, no, it doesn't. We have to file this form. You have to know what your reasonable compensation that you have to take is. You have to set that up. You have to set up payroll and make sure you're filing payroll taxes. Do all of that type of a thing. So that's the piece where we're like, we're going to get the S Corp fully set up for you, which means we're going to run a reasonable compensation report and make sure that you're taking a salary that the IRS is good with and everything, and not taking any more than that to make your self-employment taxes greater. So that's usually piece two. Usually piece one is the getting deductions out or maximizing deductions, getting that. Piece two is usually entity structuring. And then piece three becomes kind of, I would call the first more optimizing the expenses. The piece three is kind of maximizing and timing expenses and income. So, a lot of times for them, it might, like, we might say, hey, you don't need to, if you can get it down to this, we don't necessarily need to go to S Corp until next year type of a thing or something. And so then it's, if they're sitting on cash or money or something, they need to know, okay, if I pay this out on December 31st or put the check in the mail on December 31st for these items, this is what it could do. Or if I go purchase this asset or do something and I use that cautiously, because like, I'm not going to tell you go buy a car on December 31st. But if you're telling me you're trying to buy a vehicle either way, or you're looking to do that in the next 6 months or a year either way, I'm going to tell you that, we're going to talk about if you do it on December 31st, we can utilize bonus depreciation on that and, get you down, right? Like we can do, even if you're in, a lot of times people are putting, well, I only had to pay like 5,000 down or whatever I paid down on it. And the rest was a loan. And like, that's fine. The whole thing is what you paid, right, in this year. So things like that we're talking about, that's usually not, like I said, I'd use that cautiously because that's never a tax planning strategy that's going to work every year. Hey, go buy a bunch of stuff at the end of the year. But a lot of times in year one, year two, when you see that growth and you're sitting on like potential taxes, it is, which brings up the point to where I kind of touched on earlier, like, if people come to us in February with this bill for last year, we've got a couple Hail Mary approaches we're looking at. But if we get them in, like December 31st is the most important tax deadline of every year, is what I tell people. It's not April 15th, whatever other date, because after December 31st, like, our options go way down, right?
Right.
But before December 31st, there's a lot we can do, right? So we can probably get your entity like retroactive S Corp. We can probably get something purchased that you wanted to do, maximize expenses, things like that. Even potentially to the hiring kid strategies and things like that. So, those other like home office deductions, Augusta rules, like we're talking of maxing all those out. And there's some different ones that some of them like look sexy on the Instagram videos and things, and that's great, and they're not good. And some of them look sexy and do it, and they are good. And I'm like, it's just getting them to understand that and knowing which ones like can work for them.
Got it. I love it. Yeah. If you're listening to this and you don't have somebody qualified to help you with this, get one. Payton, people can reach out to you. You've got a free group as well that is it started or you're in the process of starting it right now?
Yeah. So the two things we do tax game plan, which is any small business owner investor that's looking for kind of a full tax planning approach to things. And we do, people get confused sometimes. We do your tax returns, right? We take care of the compliance. And I mean, you are able, if you wanted someone else to do them, you could have them, but all of our clients use us to do the returns. They might have an outside partnership or something that another accountant's doing and we're touching base with them, but we do their tax returns. We do that. We have bookkeeping and all the compliance that we can do as well. Just the value, we're putting tax planning at the forefront of everything we do. So if that's of value to them, if there's strategies that could be utilized or if they're looking for that, I usually am saying those are, to your point, Justin, you're probably in getting into the mid six figures or starting to in revenues where we can really start to work with you a little bit. Under that, we still possibly can. It just kind of depends on where you're at, what you want to do, and how much of your money you necessarily need and what you can use elsewhere. And so the side project kind of that we started working on. And so if anyone wants information on this, because it's not fully launched yet, we do have like a lead page of sites that's getting up, but they can also just email me and we'll get them and everything when it launches. It's going to be called REI Tax University. Mm-hmm. And it's a community that we're building because the goal for me is, and I told Justin this earlier, we never want to be like a burden on, hey, we have to pay you this fee. It's a burden. Like we want to be a benefit to them. And so there are times where people reach out to us, early investors reach out to us, and that's what we talk about. Hey, we would love to work. I'd love to educate you. I'd love to do this. It doesn't make sense. Like go make some more money. Like go do some more stuff. Like use your money to make more money right now. You'd be better spent there. And so we get that sometimes. But what I don't like doing is doing that, and then they still don't know, and they don't do things right, and then they're getting a lot of issues and things like that. Even if they're working with other accountants, just because they might be working with tax preparers who don't understand what they need to do and educate them on it. So that's why we kind of are launching the REI Tax University, which is meant for really investors of any level, from the new to the seasoned. But what we're going to do with that is create a community, post often, frequently, create YouTube channels for different strategies, and then give templates out there like real estate professional status tracker and different things like that, time logs and stuff like that we can just give these people to be like, hey, this is, and it's not meant for you to take this and do it 100% on your own. What I would say is it's meant for you take this, and you're going to probably need to educate your accountant that you're working with a little bit on this if they're not someone like you guys have who's sophisticated in real estate, because the majority aren't. Like that's just,
I was going to say that's something I had to learn the hard way, is most accountants aren't specific for real estate. And if you're in real estate, finding someone specific for real estate is worth whatever they cost.
Yeah. And what I found is that we get those people, and I would love, they'll ask us, well, do you know someone, can you refer someone who is? And I've got a couple, but I'm like, it is very hard because I don't it's not that I don't want to refer them to someone great that knows it. Just a lot of the other accounts that I know that I can refer them to, I don't know that they would be great at it. I'm like, I don't know. I can refer you to them. I don't know. So what I tell them is, hey, everyone has to captain their own ship a little bit, right? And the wealthier, the more successful you are, you're able to captain it a little less because you put teams and people in place that can captain it a little bit more for you. So you've got good CPAs, good advisors, and people that can do this stuff for you. When you're starting and when you're growing, you're going to need to captain that a little bit more. So even if you don't like taxes or you don't like social media or whatever it is, if you're bootstrapping it, you're going to need to learn about this. You're going to need to research the bonus depreciation and these rules on your own. And if you don't believe if your accountant gives you a piece of advice and you don't know that they're sophisticated in it, dig into it. Because I've seen everything. I've seen them say, hey, it doesn't matter if your spouse meets real estate professional status, that doesn't qualify you. And it does. And that, I'm like, it's right here in the code. Like, here it is if you want us to show you, type of a thing. But that's the information. I want those people to be educated enough to be like, I think it does. And then bring it to them and say, yeah, wouldn't it? And know kind of what they need to do, know when they might need to look to change or do different things. So that's really what we want to do with the community, is just give them all the information that we can to educate them and so that they can be set up well, even if they're not working with us or prior to being a good client for us or anything.
Yeah. Awesome. I love it, man. What's the easiest way for people to reach out to you if they want to work with you or join the REI Tax University? What's the best way for them to reach out to you?
Yeah, thanks. Good. The best way, email is always going to be best. So pgillis@tgpfirm.com, taxgameplanfirm.com. So that's the easiest way, best way, because if I'm not on it, Camille will get to it and she'll ping me on it and be like that. And then whether they want to look into being a client or they want to look into just, hey, let me know when that community's launched. And we'll post that out there and everything when it is. But at least if they're like, hey, I want to be on the list when that's launched, let me know, because we'll get them and we'll put them on the email so that we can let them know. That should be coming within the next month that we have all that up. You can also go out to our website, tgpfirm.com. You can contact us, put in the contact information through there and everything as well.
Cool. Well, awesome, man. I learned a lot today. I'm super grateful for you hopping on today and helping teach us some stuff and providing a lot of value. I really appreciate your time today, man.
Yeah, you guys as well. I appreciate you guys having me on. I think I love the podcast, what you guys do. And I've listened to several other episodes during my evening runs and stuff. So always enjoy listening to your guys.
Oh, cool, man. Yeah, I appreciate it. And, this might turn into a second call where we dive a little bit deeper in the future as well on some other stuff that people come up with questions. So really appreciate you coming on. I think this was great.
Awesome. Appreciate it, guys.
Awesome. Thanks, man.
Have a good day. See you guys.